Well, hello everyone, and welcome to Superior Gold's live summit today, hosted by SIX. We're joined today by President and Chief Executive Officer Chris Jordan and CFO Paul Olmsted. Chris and Paul are going to walk us through a company presentation, and after we will be accepting questions live. So as a reminder, you can submit your questions at any time on the Q&A panel on the right-hand side of the screen, and we'll make sure to get to them after the presentation. And as always, the summit is being recorded. It will be available to watch afterwards on six.com. But without any further ado, I'm going to hand it over to you, Chris, to kick things off.
Thank you very much, Dasha, and good day, everyone. Thank you for joining me to get an update on Superior Gold, and thank you for hosting us today. As a reminder, please refer to our slide 2 of our presentation, which is posted on our website, to view our cautionary language regarding forward-looking statements, please. Also note that the dollar amounts in this presentation are in US dollars, unless otherwise indicated. So Superior Gold is a TSXV, if we go to this next slide, is a TSXV listed gold producer that owns 100% of the Plutonic gold operations located in Western Australia. The Plutonic gold operations include an underground mine, the Hermes open pit projects, which is on our property, and 80% interest in the Bry Basin joint venture with Alchemy, and now the Plutonic main pit pushback project. We hold a large prospective land package along the Plutonic-Marymia gold belt with several deposits in close proximity to our current infrastructure. Plutonic is situated, if we look at the investment highlights, it's situated in one of the top mining jurisdictions in the world, according to the Fraser Institute. It's a world-class operating mine with related infrastructure, and I'll show you a little bit about that in the next few slides. The business has a clear and concise optimization and expansion plan, and I'll share that with you momentarily. And it's endowed with a significant mineral resource base with exploration upside, and I'll allude to that a little bit later, where we give you a bit of insight as to what our exploration results look like. And finally, one of the most compelling attributes is the re-rate opportunity we represent compared to our peers. In order to achieve a re-rate, our strategy is to deliver 3 goals. The first one, a safe, stable, and predictable operation of between 75 and 80,000 ounces of gold. The second goal is to provide an operation of scale, which will see it move up to 100,000 ounces per annum, and then ultimately, as we start unlock the latent capacity in our 1.2 million tons per annum mill, which is currently in care and maintenance, take it up to 150,000 ounces. Now, needless to say, with that comes a lot of fixed cost dilution, and we would expect quite a significant reduction in cost, providing more headroom relative to the gold price, and then ultimately also improving our net cash position. The third goal is investing smartly in exploration, and there is making sure that we understand very clearly what the high potential target areas are, and there's a lot of technical work happening in that space at the moment, and we've been very successful with the areas that we have targeted, and as I said, I'll allude to that a little bit later. Moving on, just to give an indication where we're situated, on the left side, we hold 644 square kilometers of prospective land along the Plutonic-Marymia gold belt. On the right-hand side, you will see there's several other gold deposits in close proximity to our existing infrastructure, and that's a very important strategic advantage for expansion, specifically as it pertains to the second mill, which is currently in care and maintenance, as I referred to before. Now, quickly jumping forward, just to give you an idea of what the infrastructure looks like, you'll see to the left-hand side is the open pit. The grey shaded area is basically an indication of all the workings underground that has happened over the years. On the right-hand side, between the TSF and the open pit, is our processing plant, and you will also see a number of the other open pit mines or pits that were mined previously. One worth mentioning there, Plutonic East, which is to the east on this picture. Then moving on to our growth strategy, and this is a very important slide to understand how we are embarking on achieving those 3 goals that we set out. Firstly, it is underpinned by 4 main enablers. In phase 1, or enabler 1, is designed to deliver a safe and stable, predictable operation. Now, first, we're working to re-establish the steady-state production from our underground mine and to increase production from the underground mine. And we're encouraged to see it return to a state of improving positive cash flow in both the first and the second quarter of 2021. The near mine resource extension drilling and mineral exploration currently underway seeks to provide new mining fronts for stable, cost-effective feed to mill, and we're already seeing that coming through in FY22, the results of that drilling and the way that we approach our underground operation. Enabler 2 and 3 is basically phase 2 and 3 will deliver an operation of scale, first taking up to 100,000 ounces, then 150. There's two very specific goals or elements to that. The first element is unlocking the potential of past operating open pits, and to that we have a number of options. We've already started and finished Plutonic East. We're now into Perch. We have options into Hermes South, and very excitingly, recently we are considering an early entry into the main pit to augment open pit feed to our operating plant. What that will ultimately provide would be sustainable feed in addition to the underground, and ultimately increasing the average grade of feed into the process plant. Phase 4, Enabler 4, focuses to deliver on the exploration of known high potential targeted areas. Now, there's a potential for a new discovery as we invest in exploration at Plutonic. Now, we have certainly been very encouraged by the recent results that we've achieved, and we now have a third drill rig underground, which is specifically focused on opening new mining fronts for the underground mine. And then just moving to the next slide, around sustainability and diversity, a very important element to our business. We're committed to mining responsibly and developing a diverse workforce as we further enhance elements of an ESG strategy. For example, our workforce comprises of people from all across the world. In addition, we utilize an international ecosystem of specialists, especially on technically complex matters, to drive innovation. Over the past 2 years, Plutonic has actively increased its engagement with the Jiri Jiri and Jinjarana groups, who are the historical landowners and custodians of the land on which we operate. Appropriate agreements have been established, and we continue to develop these further, setting clear terms of engagement on the land. Moving on to the guidance. Our production for 2021 remains unchanged as we continue to guide towards between 65 and 75, and recently we made an announcement that we in fact guiding towards the upper end of production on the back of very strong Q3 results. Now, expanding a little bit on the underground optimization. So we're currently focused on unlocking the value in the underground, which is going to be the mainstay of the feed to the first mill. That is the 1.8 million tonnes per annum mill. And there's a number of elements related to it. Firstly, we focused on optimizing our grade from the underground, and we've been very successful in achieving north of 3 grams per tonne stoping grade. In mining operations, we've revitalized our underground fleet with the addition of 2 new trucks and 2 new loaders, and they proved very successful with a significant increase in productivity of those units. At the mill, which operates very well on the recommendation of external consultants, we've restarted the gravity circuit, and that has helped a long way in increasing product recovery from the low 80s to the mid 80s. Finally, the addition of the third underground drill rig, as I referred to before, is dedicated to expanding into new mining fronts and has resulted in some very promising results, which I will discuss very shortly. Now, moving on to our improved production and financial position, I'd like to hand over to Paul to give you a little bit more insight into this exciting journey that we're under.
Sure, thanks, Chris. Just on the left, you can see we were at a bit of a low in terms of our production in Q2 2020 at just over 15,000 ounces, and we've had a steady improvement through all of the initiatives that have been implemented to Q3 2021, where we produced over 19,000 ounces. And commensurate with that, we had a significant increase in our net cash position, with net cash being the cash less the gold loan that we did have outstanding. That was repaid at the end of June 2021. And so for the third quarter of 2021, we had no loan repayment, and that was costing us about $2.5 million US per quarter. So at the end of the third quarter of this year, our balance sheet has improved significantly, and we have $20.5 million US on the balance sheet, which represents roughly about 25% of our market cap. Back to you, Chris.
Yes, thank you very much. If we can jump to the next slide. I think this is a very important element in understanding how we've improved the operations. Apart from unlocking the potential in the underground, we've moved away from stockpiled historical low-grade ore, which we fed into the process plant, and now moving into virgin ore from our open pits. And as I said, we've got a number of open pit opportunities. We've already started Plutonic East, in fact, finished it. We're well underway in Perch, and I visited the mine this morning on site. It's really looking well. The guys are hitting good grades at this moment. So needless to say, what we're seeing is an increase in grade from into the mill. And it's important to understand that the underground relative to open pit is about a 53% underground, 47% open pit. So needless to say, the open pits do play a very important role in the average grade that we're feeding into the process plant. We've also commenced an opportunity review, and we were able to extract a lot more value by design from our initial designs that we had for these open pits. And we hope to see that continue further as we expand our options into Hermes and Hermes South for further open pit feed. I also mentioned potential early entry into the open pit. Now, in the next slide, I'm going to talk about the PEA and then bring back to what we're talking about when we say early entry into the main pit and why that's so important at this stage of the strategy. You can go to the next slide, please. Now, on one of the previous pictures, you could see there where the main open pit is. What we've done in 2020 was to do a P&A for a major or main pit pushback project. Just a few salient numbers there. It's going to require about 82 million Australian dollars, but it's quite a sweet deal. We're looking at about 360,000 ounces over 6 years feeding into the process plant. Now, it's very important to understand that this specific project is designed to augment feed into the 1.8 million tonnes per annum mill, not the current mill, which is currently in care and maintenance. I'll talk about that in a moment. So I think the key for us there is there's certainly a lot of gold in there, very low cost. However, the capital is quite significant. What I tasked the guys to do is to go and have a look at potential options whereby we can have early entry, low cost, low capital entry to try and get as much value as we can as soon as possible out of the open pit without sterilizing any of the remainder of the 360,000 ounces. Now, that work is currently underway. At this stage, it's quite promising. We initially identified 3 targets. At this stage, 2 of them have been delimited, and we're specifically focusing on one area. At this stage, we're looking at the depletion of the ore in the underground because it's in the main pit, right at the bottom of the main pit. So needless to say, quite close to underground working. So technically complex, but certainly holds a lot of value. And we believe that if we can make this work practically, we'd be able to pull in quite a significant portion of this NPV earlier than initially anticipated. In looking at low-cost expansion potential that we have, I think this is important to understand that what is the inherent full potential from a gold production perspective when looking at the average grade that we feed into the mill. Now, you'll see there in the table on the right-hand side, it's production using 1 mill, that's the 1.8 million tonnes per annum mill, and then adding or restarting the 1.2 million tonnes per annum mill, which is currently in care and maintenance. At an average grade, conservatively at 2 grams a tonne, we're looking at about 100,000 ounces and then bumping up to 150,000 ounces. And that's to a large extent on which we're hanging our hat into the future on how we're going to get to the 150,000 ounces. So I think the key message here is the full potential is there. The installed capacity is there in the processing plant. We need about 20 to 25 million Australian dollars at a very high level to get the mill, which is currently in care and maintenance, back up and running. The key here is to get the right ore for this process plant because it needs quite a specific type of oxide ore. The benefit that we have is we're probably the only operation within 150 kilometer radius that has latent milling capacity. And milling capacity can get going relatively quickly. So we are in the process now of looking at options outside of our property to find ore supply for this mill. I think the next step that's important to talk about is on our exploration upside across Plutonic. Now, this slide highlights many of the high-grade drill results that we've intersected since acquiring Plutonic. It is clear that Plutonic is a very large, underexplored mineralized system, but it is complex. But within that complexity lies a lot of opportunity to extend the mine of life. life of mine, sorry. Just moving on to the next slide. This slide is a reminder that there are significant intercepts in close proximity to the existing infrastructure, as well as ore-grade intercepts located 1 kilometre outside the mineralised mafic. Now, that's what makes this so important. Because it's so in close proximity, it's right at the milling plant. Needless to say, it certainly supports our strategy to expand, to become a lot more explicit around our exploration aspiration, specifically on our property, because that's probably going to be the lowest cost and cheapest ore that we can access. Moving on to the next slide. In the near term, our focus in the underground is in exploring and developing into new mining fronts, and you would see there Baltic Deeps, Baltic and Indian being the main focus, as well as Baltic Gap, which will be the new mining areas that we'll be entering. You can see the red bars, which is an indication of where we've done drilling, and the reports that we've sent out on a quarterly basis, and I'd like to refer you to that. It's on our website, gives you much better indication and colour as to what those results look like. So what has this led to? Firstly, we've had a significant increase in our reserves since acquiring Plutonic, measured and indicated resources as well as inferred resources. Now, you might say, well, at 400,000 ounces, I think it's 380 on our declared 2020 resource and reserve statement, seems to be quite a low number relative to our measured, indicated and inferred resources. I'd like to comment on that and specifically say that we've done a lot of technical work in understanding the spatial positioning of the ore in the mine, and therefore we are in a process now to redo the block models. That will feed into the scheduling and planning for the mine and setting up the new life of mine, and needless to say, the reserves. And we expect to complete the first portion or the first portion of the technical work at the end of November this year. And we will be publishing a new resource and reserve statement towards the end of Q1 next year. In that, we would hope that there is quite a movement on our reserves, which will give the market more confidence as to the life of mine and the expectation of the life of the operation going forward. On that, just moving on to the upcoming catalysts. So we have a number of upcoming catalysts worth noting. Firstly, going forward, we expect to provide more regular underground exploration updates. And quite frankly, we are in the verge of completing the next announcement of our exploration work, which is specifically related to the new Western Mining Front, which I referred to in one of the previous slides. That'll be out in November. We hope to follow that up with a bit more detail on some of the other areas underground that we're drilling. And on a quarterly basis, you can expect an update in the market insofar as our exploration is concerned. In addition to that, this quarter we've started on surface exploration work. It's near the process plant, and we hope to give an update to the market either in Q1 or Q2 next year. In addition to that, we're in the final straits of completing our full potential assessment, and I alluded to that a little bit earlier when I talked about mill capacity, and we hope to inform the market soon as to exactly what that full potential looks like for our operation. We also expect to be commencing and announcing results of the heritage surveys, which we will hopefully have some positive impacts on the main pit pushback project and make clearer the timing of the Hermes South project. Over the next 12 months, we have a healthy pipeline of development and, of course, exploration catalysts to look forward to. Insofar as the capital structure is concerned, Paul, I'd like to hand over to you if you can take us through that.
Sure. At this point, we're sitting out with about 122.7 million shares outstanding. We've got a number of acquisition warrants of 14.4 million that were issued at the time of the acquisition or at the time of the IPO back in 2017. Those have a term until about the middle of February next year. The exercise price is $1.52 US. So barring a significant move in the share price, it's likely that those may expire. So that would certainly, tighten up the share structure, following the expiry of those. Just in terms of our market cap, just at the end of November 12th, we're sitting at a market cap of about 90 million. and US cash of 20.5 million. So I think we're in a reasonable position financially relative to where we were prior to that. Just in terms of shareholders, you can see we've got a pretty good set of institutional shareholders, with the management and board holding 2.6%. So certainly some skin in the game for management. So back to you, Chris.
Yeah, thank you very much, Paul. I really appreciate it. I think just in closing, I quickly want to just run through our strategy and what the three main goals are that we're after. The first one is to provide safe, stable and predictable operation of between 70 and 85,000 ounces. And I'd like to inform you, if you haven't had a look at it yet, on an annualized basis in Q3, we were very close to the 80,000 ounces annualized production. And then moving on to the second goal is providing or taking the company to a business of scale, which has got two subset or sub goals in there. The one is getting it to 100,000 ounces. In essence, there is unlocking the potential in our open pits. And that will, of course, at this stage still exclude the second mill. As a second step, taking it up to 150,000 ounces will be the securing ore supply from potentially external ore sources to get that second mill going. That'll add another 50-odd thousand ounces on top of the 100,000 ounces that we will achieve in the first mill. And then the last goal is about smart exploration. So we focused on repositioning Plutonic for the long-term success. And by doing that, we want to make very sure that we understand our ore body really well, and also understanding what the potential options are for further mining on that property. So with that, I will conclude the presentation. Once again, thank you very much for joining us. And I'd like to open the table for questions. Thank you, Dasha.
Great, thank you so much. So yeah, if you do have a question, feel free to submit them now. We already have a bunch. Tim has a question. How many meters of drilling are planned for 2022 and at what cost?
That work is currently under consideration. It's going to be part and parcel of our budget. We will be approving our budget in December, taking it to the board. In fact, I'm having a presentation tomorrow to get a first round view exactly what that's going to look like. So unfortunately, I won't be able to tell you exactly what that is. What I can say to you is that we are planning between 4 and 5 drill drives for the underground. That is in addition to the surface drilling that we will be entering, both around the TSF area as well as other potential targets on both our property, which we own 100%, and of course the Bry Basin joint venture. So I think the key message is we're setting ourselves up for the long term. We're putting ourselves in a position to understand much better what's happening underground, but also looking at all options on surface, both on our own property and our joint ventures. Thank you, Dasha.
Thank you. Jan has a question. He's actually following up from his question at the last summit. He says, hello, Chris. We are well on our way to $5 Canadian. Like I asked last time, you are well building further on the fundamentals of tomorrow's work. To accelerate the expansion, would Goldspot Discovery's AI tool, LithoLens, not be an option?
I don't think I have an answer for that correct at this moment, but if I can take that on notice, Paul, if you can make a comment or just make a note on that, I will certainly get back to him on that question. It's going to be very difficult for me to answer that, so apologies for that.
Yeah, I think one of the key things, though, just on that a little bit, is that we've been doing a lot of work using the Leapfrog, and I mean there is a significant amount of historical data that we are using. That is guiding us in our updated reserve and resource using the Leapfrog technology for the ore body. So I think that's it has been helping us, but certainly we'll take the other comment online.
Great, thank you.
I think the key there, just maybe if I could technical work, Leapfrog has certainly allowed us to reconsider the spatial positioning of the ore body, specific in the underground. We've done a number of trials to verify and validate that work, and it seems to be checking out. We're certainly becoming more accurate in predicting through form interpolation where the ore is, and that's very important. If you go back in history of this mine, about 50% of the ore that's been extracted has been outside the reported resource. So it gives you an idea of the complexity of the ore body. And it seems like we're certainly getting to a position by which we're becoming more accurate in predicting where that ore is. So we'll be able to predict much more closely relative to our resource and reserve where we're going to mine and get the ore out.
Great, thank you so much. Tim has another question. What is the average grade of the open pit?
What is the average grade?
Yeah, of the open pits.
Okay, depends which open pit you talk about. If you talk about Perch, it's probably running at about 0.6. If we talk about Hermes South, probably to the tune of about, it depends where you mine, 0.8 to 1.1 grams per ton. And I'm probably being a little bit conservative here, but that's probably better than overstating it. When you get into the main pit, it certainly increases, probably goes up to, on average, depending where you mine, of course, but probably to the tune of about 1.5 grams a ton. So I think the open pits are certainly not at the level that the underground is. I mean, as you know, from the underground, on average, we're getting about 3 grams a ton out of the stopes, which, as I said before, will be the mainstay of our feed and supply of high grade.
All right, thank you. Jan is asking, how much may the stock price be now if it's properly priced?
Well, that's a function of what you believe the NAV is, I guess, and whether the market really understands what the future of the business is. I think at the end of the day, it's very difficult to predict what that might be. We know we've got a number of what we believe the company is worth, and we're doing everything in our power to increase that NPV through the projects, and that's why we did the opportunity review. I think the recent movement in the market just goes to show that there's a lot of fuel in the tank left. We've been very blessed with some really good results very early in the turnaround program. There's still a long way to go. As I said, we're at 80,000 ounces almost annualized, pushing very hard in Q4 to move towards that. We have line of sight taking it to 100, and if all goes well and we can secure ore for the second mill, 150,000 ounces is potentially, up for grabs. What the valuation will be, I think, to a large extent, not only what our production is, but what is the extent to which we can increase our margin. I mean, currently at our cost, which we presented, I think on a year-to-date basis, we're at $1,494 an ounce US. That's certainly not a dripping tray. There's a lot of opportunity to bring that down further. The one thing that I would like to add there is that moving up from about 80,000 ounces annualized up to 100,000 ounces, a large proportion of that will only come at variable cost. So we would expect quite a significant fixed cost dilution, and at a ratio of about 60-40 fixed cost to variable cost, you can expect quite a significant reduction in cost. In months where we had really good production, we could see that flowing through immediately. So we're looking forward to seeing, as we increase the production to 100,000 ounces, to get that cost in line with, which I think is commensurate to the grade that we're mining.
Chris, just maybe for interest, maybe we should just go to slide 27 in the presentation, and you can get a sense of the revaluation opportunity that we're presenting, and the fact that we're well below, on our price to NAV ratio, our price to cash flow ratio. So, I mean, if we were to move to the average, I think, I think you could see that there's certainly an opportunity here that we see to get back to where the average of the market is. Slide 28, effectively shows the same thing on enterprise value per ounce and enterprise value for total gold resources. So, certainly on a strong revaluation opportunity for Superior shareholders.
So our strategy there is to provide consistency and transparency. The second piece is to take this business to a level of scale, as I said before. And the third one is to provide a story of the future. And the story of the future is, what do we have in the ground? What is the future of that? What's the life of mine? What can we do to increase our reserves? And that will give the market, I hope, a lot more confidence based on, or supported, augmented by really good quarterly performance.
Absolutely. Stephen has a question asking, do you plan on making your 3D models public with something like Verify?
Well, we haven't yet considered that. I think the one thing that has been quite a significant learning, and I don't think we're the only operation that's used this technology to in a similar fashion. We're probably using it to a much larger extent than others. That's anecdotally what we've heard. I think what's important would be to be able to demonstrate that through consistent delivery relative to what we put out there in the market, what we're trying to achieve will give a very good, strong indication as to the validation and verification of the Leapfrog models that we're using. At this stage, we're very encouraged with the results. Is it 100% correct? No, it's not, but it's certainly better than what we had previously.
Thank you. Tim is asking, are you hoping to have the second mill operational in 2023?
Sorry, 2020?
2023.
So I would certainly like to get it running as soon as possible. Maybe just a bit around timeline to give you a bit of picture and context of what it will take to get it up and going. We need between 9 and 12 months to do the technical work to get it up and going and spend that money to refurbish some of the rotating equipment. More specifically, from a fixed plant perspective, we seem to be okay. The overall conditions in that area and the environment within which we operate is very amenable for very effective care and maintenance. In addition to that, the other key bottleneck or constraint would be access to ore. The opportunities that are out there at the moment are not shovel ready. It's going to take a number of months to get them up and going. So I would be very hesitant to commit on exactly when that's going to happen. It depends, how quickly we can secure the ore supply. And then, under the current circumstances, get that mill ready for operation. I think on the positive side, however, it's a mill that's run really well. It's technology we know. It's relatively off the shelf, well-known operational requirements. We can in fact use, to a large extent, our overhead structure at the process plant to run it, with the addition of a few operators and maybe 2 to 4 additional maintainers. So I think from that point of view, it's not really complex. So it's really the time to get the process plant ready to go, and the other one is then the secure of the ore. So FY23, I think, will be the very earliest that we would probably be looking at. But it's because that ore supply will come from external parties. It's very difficult to say how long it's going to take to secure that, unless we have a significant find on our own property.
Okay, thank you. John is asking, if you decide to enter the main pit early, do you have an estimate of grade and how long will the feed last?
It's not going to be a long-term feed. It's definitely not going to be the 6-year feed or close to the 6-year feed. The grade we're currently confirming at the moment, as I said, we confirming the depletion of the underground, which is very in close proximity to where we're going to mine the open pit in the lowest or the deepest end. So that work is still currently underway. The initial indications that I've received seemed a little bit, I think, optimistic in my mind. So the operations team is back into the pit trying to get a better view as to what those numbers might look like. So we certainly want to lock that in and understand exactly where we're going with the early entry into the main pit before the end of this calendar year, if all goes well. So maybe that's a question I'll be able to answer, in a few weeks' time. There's a lot of work going in there at the moment.
Okay, perfect. Gert's asking, what do you see as the most important risks specific to your company and operations?
The most important thing?
Most important risks.
Oh, okay. Without a doubt is our safety performance. It's certainly not a safety performance that I'm comfortable with, and I don't think anyone on site is comfortable with it. To that extent, in October, we started off with the People Safety and Risk Transformation Program. which is a multifaceted, multi-phased program that, in fact, will start in October. Has started in October. And that's specifically designed to understand 4 things and to improve in those fronts. Firstly, on the job safety, so around critical controls. The second one is around safety leadership and understanding and clear articulation of roles and responsibilities of both operators, maintainers, as well as the supervisors. The third element to that is about process safety. And the fourth element is understanding very clearly what our material risks are. And although we haven't really had a good grasp of it up to recent times, by the end of this year, we will have defined and bow-tied the top 5 material risks and have action plans and controls against that to better shore up the future of the business. So a lot of work happening in that space. It's certainly the thing that keeps me awake the longest or the most at night. I think the second thing, as far as that is concerned, would be making sure that we prepare specifically the underground resourcing appropriately for our ramp-up program on the underground. As I said before, the underground is the mainstay of our supply to the main mill. It's where the high grade comes from. It's got a long life ahead of it. We believe, the leapfrog analysis is pointing towards that. So it's making sure that we fully unlock that potential in the underground by making sure we have enough solos, enough trucks, enough jumbos, enough people to man them up.
Thank you so much. John has a question here. He's asking, does the opening of new underground mining fronts mean the end of remnant mining? Will it mean improved grades, lower costs, or both?
Okay, so there's a number of questions in that one. All right, so let's first start. It is not sustainable to keep on doing remnant mining. Therefore, we will, over time, move away from remnant mining more and more until we get to a point by which we predominantly mine in new mining front areas. Initial indications is that we're probably going to be between 20 and 30% new mining fronts in FY22. That needs to be confirmed, and I'm very clear about that because we're still doing the budgets. But that's what the early indications on the schedule and planning is showing. That is in comparison to 100% remnant mining in this year. So it's a significant step forward from that perspective. Will it be cheaper? Well, firstly is how close, one needs to ask how close are those new areas? They are in close proximity to current infrastructure, so we do not expect to have significant capital investment required to enter these fronts. So from a capital expenditure perspective, I think low cost entry. Certainly by moving into new mining fronts, we can set them up more cost effectively. So we would expect more productivity and more efficient and effective mining practices that we can apply. The mining method that we'll use will probably be the same. However, I think with the leapfrog work and the form interpolation and better understanding of the spatial positioning of the ore, we'd be able to better design our stopes as well as our development front. So we would expect an improvement in cost as well as productivity. Insofar as grade is concerned, I think the jury is still out on that. There's certainly some very positive indications that we've had from our drill results. Certainly, we're firming that up further. And I think the fact that I've mentioned already that we're planning additional drill drives gives you comfort that we're serious about entering these areas and that the initial drilling supports further investment in our drill drives to better understand and shore up that specific area. So once those results come up and we firm it up, we'll certainly let the market know as to where we think the grade is going to go. At this stage, indications, and I'm saying very clearly, indications at this stage is that our target to stay around the 3 grams per ton on average out of the stopes seem to be holding up.
Great, thank you. That was a big question. Jan is asking, what is your percentage mix energy, electric, diesel, gas, and is this hedged?
So we have a long-term contract on gas, and it's all gas-fired. We have diesel as a backup.
Thank you. And I believe our last question here is from Tim, and he's asking, will we have drill results soon?
Yes. So I have a report on my desk that I need to go through. We hope to put that in the market before the end of this month. If all goes well, we'll have another report going out definitely in February next year. What we are trying to do is try and get another interim report coming out in between these two reports. So at the minimum, you may expect on a quarterly basis, typically in the middle of the quarter, so 4 reports on an annualized basis. And, if we do find something that is of significant interest and we believe the market needs to know it up front, we're certainly not going to hold back. So there is a potential of an additional report going out this month, but I don't want to hang my hat on that. We're still going through the numbers and making sure that it stands up. But certainly you may expect on the Western Mining front an update in November this year.
Excellent. Well, that's a great place to leave off. Thank you so much, Chris and Paul, for taking us through the presentation and the live Q&A. Thank you also to everyone who attended and asked all these great questions. If you do think of another question following the summit, feel free to contact the Superior Gold team directly. Their information's on this slide, but you can also find more information at superior-gold.com. And as I said earlier, the summit is being recorded, so you can rewatch it on six.com. But before we close out, I'll just pass it back to you, Chris, for any final sentiments or words.
Yeah, thank you very much. I think Superior Gold, if the last few weeks is not an indication of how much fuel is in the tank and how much re-rate opportunity resides within Superior Gold, it certainly warrants a new look at it. We've got a very clear, very succinct, in fact, quite a simple strategy how we want to grow the business. I think, do we have all the answers now? No, we don't, and we're very clear about it, but we're working fervently and very hard to make sure that we understand what the underlying building blocks are of these opportunities and how we're going to bring that to fruition. At this stage, I'm very encouraged with the extent to which the team is pulling together and delivering on the interim results as we've shown. It is a significant change from annualized 60,000 ounces a year, and we're now heading towards 80,000 ounces a year with a clear line of sight to get to 100,000 ounces. And I know there's been a lot of talk in the past about hitting 100,000 ounces. I think indications are that we're heading very strongly towards that, but that certainly doesn't take away from all the hard work that still lies ahead of us. I think the biggest challenge from that perspective is making sure that despite the challenges on the underground and getting that throughput up, we need to get high grade from our open pits to augment the underground, and the numbers will be there. Inherently, the capacity or full potential is there. The potential in the assets is definitely there to deliver it. It's basically in our hands as a team to deliver on that. Paul, I don't know whether there's anything you would like to add.
No, I think just given the improvement in the financial position over the last year, it certainly gives us that flexibility to act on a lot of the opportunities that Chris talked about earlier today.